McDonald's is in trouble, and it all comes down to higher prices. For decades, people have counted on McDonald's for cheap and quick meals, but that's starting to change. Prices have gone up and customers aren't happy.
Call with investors, McDonald's said food, labor and paper costs had risen by as much as 40%.
Some are complaining online.
I said yes. Tell me why it was $17.
While others are skipping McDonald's altogether and looking for better deals elsewhere. It's not just a small price increase either. A meal that used to be an affordable option now costs almost as much as food from a sit-down restaurant. With rising costs everywhere, from groceries to rent, many people are being more careful about where they spend their money. And for some, McDonald's just isn't worth it anymore. So why are prices going up? There are a few big reasons. The cost of ingredients is rising, wages for workers are higher, and supply chain problems are making everything more expensive. But there's another reason that not everyone talks about: the rising cost of online advertising. Since McDonald's relies so much on digital ads to attract customers, these higher marketing costs are making meals even more expensive. McDonald's is feeling the heat, but how bad is it, and what are they doing about it? McDonald's used to be known for its affordable meals, but lately customers are noticing that their favorite fast foods are getting more expensive. In just the last few years, prices have jumped significantly. A Big Mac meal that once cost around $5 is now pushing $10 in some places. Even basic items like a McChicken or a small fry aren't as cheap as they used to be. So what's causing these price increases? One major reason is inflation. The cost of everything, beef, potatoes, dairy, and even the paper used for packaging, has gone up. When suppliers charge McDonald's more for ingredients, those costs eventually get passed on to the customer. Another issue is higher wages. In many states, the minimum wage has increased, and McDonald's, like other fast food chains, has to pay workers more. While this is good news for employees, it also means higher menu prices to cover those costs. Supply chain problems are also playing a role. The COVID-19 pandemic, shipping delays, and global conflicts have made it harder and more expensive to get certain products. This means McDonald's is paying more to stock up on essential ingredients, which again leads to higher prices for customers. To make matters worse, McDonald's franchise owners, who operate most locations, have to deal with rising rent, utilities, and equipment costs. Since they set prices at their locations, some franchisees have increased prices even more to keep up with expenses. McDonald's is aware that customers are frustrated, but they argue that their food is still cheaper than many alternatives. While this may be true compared to casual dining restaurants, fast food customers expect low prices. When they see their usual orders costing more, many start looking for better deals elsewhere. But there's another hidden factor making prices rise: the growing cost of online advertising. Digital ads play a huge role in keeping McDonald's on top, but they aren't as cheap as they used to be. And that's a cost McDonald's can't ignore. McDonald's doesn't just rely on its golden arches to attract customers. It spends billions of dollars on advertising every year. But lately, the cost of getting people's attention online has skyrocketed, and it's adding to the company's financial struggles. In the past, McDonald's could reach millions of people with traditional TV ads, billboards, and print media. But today, digital marketing is the key to staying ahead. Social media ads, YouTube commercials, and search engine promotions are now some of McDonald's biggest marketing expenses. And these ads aren't as cheap as they used to be. Big platforms like Google, Facebook, and Instagram have increased their ad prices due to high demand and changes in their algorithms. More businesses are competing for ad space, which means McDonald's has to spend more money to keep its brand in front of customers. In 2023, digital ad costs rose by as much as 30% in some markets, forcing businesses to either increase their budgets or risk losing visibility. For McDonald's, cutting back on ads isn't an option. The company relies heavily on marketing to promote new menu items, limited time deals, and value meals. But as advertising costs climb, McDonald's has to make up for it somewhere, and that means higher menu prices for customers. With food, wages, and now advertising costs rising, it's no surprise that customers are starting to push back. But just how badly is this affecting McDonald's sales? As McDonald's prices go up, customers are starting to notice, and they aren't happy. Many have taken to social media to vent their frustration, sharing receipts and comparing prices from just a few years ago. Some are even joking that fast food is becoming a luxury. The frustration isn't just online. Fewer people are visiting McDonald's because they no longer see it as the cheap, convenient option it once was. Some customers have switched to competitors like Wendy's or Burger King, which are offering better deals. Others have decided to cut back on eating out altogether, choosing to cook at home instead. One major shift is that budget-conscious customers are skipping combo meals and ordering fewer items. Instead of getting a full meal with a drink and fries, some are just grabbing a sandwich or the cheapest item on the menu. This means McDonald's is selling fewer high-margin items, which hurts profits even more. Loyal customers who used to visit multiple times a week are also cutting back on how often they go. With inflation affecting everything from gas to groceries, people are being more selective about where they spend their money. If McDonald's isn't offering a good deal, they're willing to look elsewhere. McDonald's has noticed this shift and is trying to respond. The company is rolling out new promotions and value deals to bring people back. But are these efforts working? McDonald's rising prices aren't just upsetting customers, they're also starting to hurt sales. For years, the company relied on steady traffic and high-volume sales to maintain its dominance in the fast food industry. But now, with fewer people visiting and others spending less per trip, McDonald's is feeling the impact. Recent financial reports show that same-store sales growth has slowed in key markets like the US and Europe. While McDonald's is still making money, the pace of growth has dipped compared to previous years. This is a big deal because McDonald's depends on consistent increases in sales to satisfy investors and keep franchise owners profitable. One of the biggest warning signs came in early 2024 when McDonald's executives admitted that higher prices were driving away lower-income customers. These are the customers who used to rely on McDonald's as an affordable meal option, but now they're cutting back or skipping it altogether. The decline in foot traffic has also hurt franchise owners, who operate about 90% of McDonald's locations. Many of them have had to raise prices just to keep up with rising costs. But this has only made the problem worse by pushing more customers away. Some are even pressuring McDonald's corporate to rethink its pricing strategy, fearing long-term damage to the brand. McDonald's knows it can't afford to lose its core customer base, so it's working on solutions. The company is rolling out new deals, value meals, and promotions. But is it enough to turn things around? McDonald's knows that raising prices too much can drive customers away, so the company is trying to find ways to win them back. One of its biggest moves is bringing back value deals and limited-time promotions. For example, in some locations, McDonald's has reintroduced $5 meal bundles, which include a sandwich, fries, and a drink. These kinds of deals remind customers of the old McDonald's, when you could get a full meal without spending too much. The company is also offering more discounts through its mobile app, hoping to encourage people to keep coming back. Another strategy McDonald's is focusing on is menu innovation. Instead of just lowering prices, they're adding new, premium items to attract customers willing to spend more. For example, they've tested higher-end burgers with fresher ingredients, hoping to compete with fast casual chains like Shake Shack. However, these changes don't solve the problem for budget-conscious customers who just want affordable food. McDonald's is also expanding its digital ordering and delivery services. The company is investing heavily in self-service kiosks, mobile ordering, and drive-through improvements to speed up service and make the experience more convenient. The hope is that even if prices are higher, customers will still choose McDonald's because it's fast and easy. Despite these efforts, it's unclear if these strategies will be enough. Customers have plenty of other fast food and fast casual options, and if they feel McDonald's isn't offering good value, they won't hesitate to go elsewhere. McDonald's also has to worry about competition. Other chains are facing similar challenges but are handling them differently. So how does McDonald's compare? McDonald's isn't the only fast food chain dealing with rising costs, but some of its competitors are handling the situation differently. While McDonald's has raised prices across the board, some rival chains are focusing more on keeping budget-friendly options available. For example, Wendy's recently introduced a $3 breakfast deal and has been aggressive with promotions to keep customers coming back. Burger King, another major competitor, has been offering value meal combos and loyalty rewards to make dining there more appealing. Meanwhile, Taco Bell has leaned into customizable, budget-friendly options, allowing customers to mix and match items for lower prices. At the same time, fast casual restaurants like Chipotle and Shake Shack are gaining more attention. While they're more expensive than traditional fast food, many customers feel they offer better quality for the price. If McDonald's prices are creeping up anyway, some diners are willing to spend a little more for something they see as fresher or healthier. With so many options available, McDonald's has to find the right balance. If it raises prices too much, it risks losing customers to other fast food chains. But if it doesn't, franchise owners may struggle to stay profitable. So what's next for McDonald's? McDonald's is at a crossroads. If prices keep rising, it could lose even more customers. But if it lowers them too much, franchise owners may struggle to stay profitable. So what's next? One possible solution is focusing more on value menus. McDonald's has already started rolling out limited-time deals, but it may need to make them permanent. Bringing back low-cost staples like the dollar menu could help win back price-conscious customers. Another strategy could be adjusting portion sizes instead of raising prices. Some fast food chains have started offering smaller portions at a lower cost, allowing them to keep menu prices attractive while managing costs. McDonald's will also likely double down on digital sales and loyalty programs. The McDonald's app has been a key tool in offering discounts and special promotions, and the company will likely use it even more to encourage repeat business. But the biggest challenge will be customer perception. If McDonald's becomes known as too expensive for fast food, it may take years to rebuild its image. The company will have to work hard to convince people that it's still the best option for a quick and affordable meal. Will McDonald's turn things around, or will customers continue looking elsewhere? Only time will tell.